the important part is to make sure that your CPA is asking you all the questions and you're not asking the questions. So, I mean, there's going to be give and take in that regard, but a lot of times when people transition to provision, the gripes we get a lot of times is you ask for too much stuff.
Welcome back to Keeping It Real Estate. I'm your host, Dan Brisse. Today, I'm thrilled to let you guys know we've got Tim Gertz on the show with us. Tim is a CPA and tax partner and wealth strategist at Provision. He's a seasoned expert in tax planning and wealth strategy, especially for real estate investors like us. And just a little background, I've personally worked with Tim for 11 years, and it's been one of the best partnerships of team members that I've ever had on a team. And I like to think of our CPA as a quarterback to what we're doing in our real estate investing business. And they really are there to help get the org chart set up and make sure you're heading in the right direction day one. So it's really critical. If you don't have the right CPA on your team, this could be a good introduction to reach out to Provision and get the right CPA so you're heading in the right direction. So Tim, we're hoping that this episode, you can walk us through some year-end tax strategies and just share some tips on how to be an outstanding client to your CPA. That's something that I think I've never thought of, is how do you be a good client to your CPA to get the right results? Because that's really our goal, is to be steward of our money and work with our team members to get the best results we possibly can and just ensure that we're getting the most value from the partnership. So if you don't mind, Tim, maybe you give us a little background on just Provision and what you do, and then we can jump into some questions.
Sure, definitely. Provision, we're kind of a boutique tax planning firm. So our goal is to work on tax strategies, proactive tax strategies for our clients. Our ideal client is really an entrepreneur, someone that's looking to control their own destiny. So really everything we do and everything we talk about today, you're in planning, everything is about being proactive. So our goal is to be with you throughout your entire life cycle, whether it's you're just starting out and you've got a fledgling business, or you're transitioning out of your business, looking at estate planning, gifting strategies, things of that nature. Really want to be there throughout that life cycle and make sure that we're doing what we can to be as efficient as possible when it comes to taxes.
Yeah. With year-end planning in mind, what is the reason folks would be doing tax planning? What's the goal for both, CPA and the client?
So the goal for the client is, come 12/31, December 31st at midnight, the clock strikes midnight and there's not much you can do. Tax strategy is proactive in nature. It's not very reactive. So there's a couple things you can do when you're preparing your tax returns, contribute to a SEP or a 401k or Roth, IRA. But outside of that, there really isn't a lot you can do. So the goal with planning, especially year-end planning, is to, number one, look at where you are today and look at what we can do in the next couple of months to effectively put you in a position this year and in the year coming where you're as effective at planning and efficient from a tax perspective, because there's a lot that goes into taxes. I know we've talked a lot about this, and a lot of people say, I don't want to pay taxes. For me, it's I want to be as efficient as possible. And so that's really the goal. And it should be the goal for a client, whether or not they intend on doing anything. Planning just gives them the understanding of what they're going to owe on April 15th. So they can plan according to that. If they owe $100,000 on April 15th, well, now they've got 6 months to plan for that, whether it's investing in a CD, putting it into something that's a little more liquid, but knowing that on that date, they've got to make that payment.
Yeah. What specific areas of tax planning should real estate investors prioritize before the year end?
Number one is looking at what they have from an income perspective and what the character of income is and what is going to be happening or what did happen. So, in, let's just say 2020, 2021, where there was a lot of real estate that was being divested, the goal with planning was, let's see what we can do with the money we received from the sales reinvest that? How can we efficiently reinvest that? Do we want to reinvest enough to offset all of our ordinary income, but then retain capital gains, because the first effectively $100,000 in capital gains is taxed at 0%. So that's really what we're looking at where we are, what we're doing, what can we do, and how can we offset gains. It's just, and that is especially with the way that bonus depreciation is phasing out. A lot of that is how are we going to invest, and what is going to happen? Are we going to, so looking at 2024, what's going to happen in 2025? Because a lot of people say, well, nothing's really happened. The last couple of years have been pretty stagnant. We haven't had a lot of property turnover. There hasn't been sales. There hasn't been a ton of gain. But what does the forecast look like? Because investing in real estate provides you the opportunity to build what I call a war chest of losses, whether it's net operating losses if you're active in real estate, or passive activity losses if you're investing as a passive investor. That can effectively then be utilized when you sell a property, or let's say 25 or 26, something happens. Well, if they're good deals right now and it's a great investment, just because you can't use the taxes doesn't mean that it won't provide you benefit in a year or two.
Man, that's some good stuff. So I heard you say the first 100K of capital gains is taxed at 0%, is on a real estate sale. Is that correct?
On all, so any capital gain, so just like ordinary income, so your income, the IRS and our tax rates are marginal, meaning that they go up, they're staggered. So you've got, whether it's income, you have a W-2, the first X is taxed at 10%, then 12%, then 22%, then 24%, all the way up to 37%. So capital gains are the same. The first percentage is taxed at 0%, the next percentage is taxed at 15%, and then the last is taxed at 20%. So when you talk about, capital gains rates, and everyone says 20%, it really isn't 20%. It's just the worst case scenario that you're in. You're going to pay tax at 20%. But there is the opportunity to have capital gains at 0%. And so to be efficient, we want to do planning. Let's say you do have a huge sale or you have a capital gain. Well, let's try to offset all your other income that you have. So the only thing you have left over is capital gains. And if it's $100,000, you pay no tax. If it's $200,000, you pay $15,000 in tax on $200,000. It's a 7.5% effective tax rate. It's a pretty good tax rate to be in.
That's really good. My gosh. And then I also heard you say there that you can build a war chest of losses. So if I'm understanding correctly, what you're saying there is you invest in a deal here and you don't need the depreciation this year. That just sits around and waits for when you do need it. Is that right?
It's 100% correct. I actually just talked to a client yesterday about planning, and he's building up this chest of losses to effectively use when he walks away from his W-2 job. So he's been buying real estate for the last 10 years, continually buying. He's active W-2, can't use the losses against anything. So he's investing in real estate. That's a great investment. Well, he's hit some home runs. So his whole goal was to replace his W-2 income with real estate income. He's about to get to that point in 2 years. So when he walks away from that, all he's going to have is income from his real estate. Well, he was concerned, I've got this income. I'm going to be making $300,000 a year off of my real estate. He's got $2+ million of passive activity losses. And I said, great. You make $300,000 a year in taxable income from your real estate. You're still not going to pay tax for 7 years because you've got $2+ million of passive activity losses. So he's about to retire. He's leaving his job. He was concerned about cash flow, but now he knows when he does, he still doesn't have to pay tax for 7 years because what he's built up and planned for.
Wow, it's powerful stuff. If you guys are liking what you're hearing, this is why it's important to hire the right CPA team member to get the right information to build a plan for you. It doesn't even need to be this year. I mean, you hear this right now. We're talking 7-10 years out, and how this gentleman will retire and not pay tax for 7 years. That's unbelievable. Good stuff. Okay, so what are some actionable steps investors can take to optimize their tax situation before December 31st, or what should they be doing right now?
They should be sitting down and looking at what they've got going on. So I always talk about taxes as being a puzzle. We're just building a puzzle. Our strategy is just putting together the pieces of this puzzle to make it work for you. So without that knowledge, without knowing what your puzzle pieces look like, you're not going to be able to build that strategy. So I think it's very important. First things first is let's sit down and build the puzzle. What does it look like today? What do we have going on? What happened in the last 3 quarters? Do we have, income from sales? Do we have just ordinary income from W-2s, businesses? And then looking at what can we do, or what do we have the opportunity to do with investing in whatever it might be, real estate, whatever it might be, to offset some of that income, to not offset some of that income. Like I said, what's our goal down the road? But in order to know what we need to do, we need to know where we are today. And so that's, I think, number one, the most important thing is to get a exact picture of what we have going on or what happened in 2024. And like you said, how can we be better clients for our CPAs? Giving us the information to be able to do the planning is what makes the planning so successful. If we don't have the information, we can't plan. So
yeah, and when you guys are getting information, what information are you exactly looking for? Is it just totally what income was made, or is it income, expenses? If you own a business, what are you looking for? What's the ideal? Here you go. Help me out.
I mean, we would like, we've got a whole entire list of things that we ask for, but typically it goes off of what you had last year. If you're a W-2 employee, we need to know where you are for the year. If your wife's a W-2 employee, we need to know where she is. If you've got a business, I want to see where you are. Also want to get an idea of what you have coming up. A lot of times I've got clients that their fourth quarter is the hugest quarter, largest quarter of income that they get. Well, what's that going to look like? Because if I project off of the last 3 quarters, it doesn't really matter. So it's really just, it's individualized, but really we just need to have a snapshot of what it is that you have going on and where you are today. And then what have you done? What have you invested in? What do you want to invest in? Do you have anything in the pipeline? Are you looking at this deal? Are you looking at that deal? Are you looking at investing in oil and gas? Are you looking at investing in, a car wash, whatever it might be? Because we need to know that's a opportunity to plan for.
Understood. So for those that are new, can you explain, the impact of a strategy like bonus depreciation and how investors might be able to take advantage of it as part of their year-end planning?
Yeah, 100%. This is one of the cool things that going back to capital gains. So let's say you sold an asset. You had a rental property that you sold and it had a $200,000 capital gain, but you're passive. So you will have a passive capital gain. And let's say you had a war chest of passive losses, or let's say you're going to invest in a deal. You look at that and you say, okay, well, if I invest $200,000, let's say it's a car wash, I get $180,000, $170,000. That passive loss is an ordinary passive loss. But since you have passive gains that are from the sale of a rental property, it frees up that passive loss. And now that passive loss, which is ordinary, can offset any other ordinary income you have. And capital gains is the last thing that gets offset. So if you have a W-2 and you make $200,000 a year and you have a sale of a rental property and you have a $200,000 gain, you're going to have $400,000 of income. If you go and invest in something that throws off bonus depreciation that says, let's say it gives you a $200,000 loss. If you're passive, hypothetically speaking, you can't use it to offset your W-2 income. In this situation, you can. And so now we offset your W-2 income, which is at $200,000, let's say is taxed at 30%. And now all you have left is $200,000 in capital gains. And like I said, the first 100 is taxed at 0%. The next 100 would be taxed at 15%. So now effectively we took something and we used it to offset your ordinary income at a higher tax rate and left only the capital gains that you're going to be taxed at effectively like a 7.5% tax rate. But if you don't know it, you can't plan for it. So that's why planning becomes so important, and talking to people and getting that idea, because you can effectively plan to offset ordinary income with passive losses if you plan accordingly.
Yeah. And a thing I would add to that is that you can't do it if you don't know it, but you really can't do it if your CPA doesn't know how to position you for something like this. And we, in our business, we've got 874 investors who've invested with us, and we often have questions from our LPs CPAs on what is going on. Does this apply? And a lot of times, we shoot it to you guys and say, hey, here's a CPA's question from one of our passive investors. And I don't think there's ever been one time, I can say actually, there's never been a time where you guys didn't have clarity on how the law was written. Because you always say, well, yeah, if you can give us some data on that, or what do you, I can't remember exactly the term you used, but send over the papers or the terminology to show how they think that happens. And never have I ever overseen it overturned. So the quality of your CPA is remarkable. How night and day it was. The story, I think you remember this, Tam, way back in my snowboarding days, I was making pretty good money as a snowboarder, but I had a really large tax bill every year. And that was when I got with you guys, and you're like, well, hey, if you position yourself this way and you start to own assets and you can use, my wife as a real estate professional, we can set you guys up in a way that's much more advantageous. And so I just think back to that, how important that was, and how that information, had I not gotten with the right CPA, how much different place I'd be in right now. So just for those that are listening, hey, I don't know if my guy or gal is the right one. It's easy to get a second opinion and reach out and, make sure that you've got the right team member helping you understand the laws as efficiently as you can.
I think the important part is to make sure that your CPA is asking you all the questions and you're not asking the questions. So, there's going to be give and take in that regard, but a lot of times when people transition to provision, the gripes we get a lot of times is you ask for too much stuff. Like, why are you asking these questions? My prior CPA never asked these questions. Even down to, I've had situations with syndicated partnership returns where they say, like, we say, hey, can we get the PPM and operating agreement so we can review it? And they say, why? Well, because to prepare a partnership tax return, I have to read the operating agreement. That's part of the tax code. And they'll say, well, my prior CPA never asked for that. So it's just one of those situations, like, the more questions your CPA is asking, the more fact finding your CPA is doing, the better off you are going to be, because then they get to understand everything that you're doing and what makes you tick. If they're just asking you for tax documents and then spitting out a tax return, they're not really providing the value that you should be looking for in a CPA.
Yeah, it's good stuff. Are there any commonly overlooked deductions or credits that real estate investors should know about that are, often missed?
A lot of CPAs, a lot of tax preparers don't understand passive activity loss rules. They don't understand how they interrelate with each other. Like I said, the example of the capital gains, they don't understand, like, hey, we can do this. Like, you've got a gain and you've got all these passive losses. Well, this is going to actually work out. Do you have anything that we can do to free up ordinary income that's going to be taxed? To me, I hate using passive losses on capital gains, because if you're taxed at 20%, you're at a pretty preferential tax rate. If you're taxed at 15%, you're actually doing pretty good. But if I can say, hey, what else do you have going on? Are you a business? Can you go out and generate more revenue? Are you going to have an income event in 2025? We can pull to 2024. It's going to have ordinary income that we can offset with these passive losses that get freed up. Things of that nature are things that are a lot of time overlooked. Other than that, as an investor, if you're a passive investor, there's not really a lot of deductions that are afforded to you by the tax code. But it's important to make sure that your preparer understands what you're doing and what opportunity there is in just bonus depreciation. What's that going to look like? How does that work? How does that work with your state that you live in? Do you live in a state that conforms to bonus depreciation, that doesn't conform to bonus depreciation? There's just a lot of little nuances there.
Yeah. Yeah. And when you guys are based out of Arizona, you have clients all over the country, correct?
Correct.
Yeah. So you'll help your clients, no matter where they are in the country, to get clear on how the depreciation would fit their situation in their particular state, correct?
Correct. One of the nice things we have with scope and size of our firm is we have the ability to spread out expenses over a large swath of employees. So we've got a research software that's pretty robust, and it has all, like you had said, we always come back with source and guidance. That's always when I see someone ask me, or question something, I just say, can I get, the codes and regs or some sort of source documentation that supports what your position is? Because I'm not the smartest person in the world. I don't know everything. I never said I do, but I do have a very robust tax research software that also has all 50 states. So it's one of our benefits of size is that I can spend $60,000 on a tax research software that will give me the ability to do the research and get to the level that I need to be comfortable. But yes, so we have that with all of our clients. We do our called nexus studies to see whether or not people need to file in that state, what that looks like. You see a lot of times with K1 investments, you've got multi-state investments, you've got withholding in multi-states, whether or not it makes sense to file in those states, what it looks like. So we do all of that.
That's great. What are some proactive ways clients can communicate or work with their CPA just to achieve better results? Is it just be quick when you got questions, be clear, make sure the data is accurate? Is that really the biggest thing?
Yes. And make sure that you're communicating. A lot of times people are afraid. I always use this horror story, and I have a couple horror stories, but I've got one. I had a client that was 59 and they pulled $500,000 out of their 401k. If they were like 59 in 3 months. It was ridiculous. If they had just waited another 3 months before they did that, that would have saved them 10%. So they lost $50,000 that we couldn't have done anything. And I asked my client, and he said, well, I didn't want to pay you for an hour worth of your time. So he lost $50,000 because he didn't want to pay a couple $100 to talk to me. As I say to all my clients, anything you're doing that is a large income event or anything that you're doing that's going to change the structure of how you do things, you should have an attorney involved in it and your CPA involved in it. Like I talk to you guys all the time, and we work pretty closely. Anytime you're doing a deal, we're reviewing things. We're working with the attorneys to make sure it's structured properly. Because again, being proactive is easy. Being reactive is extremely difficult. And if you don't tell your CPA what you're doing, there's not much that they can do. And you can't really get upset with them when they tell you there's nothing we can do because you didn't give them that information.
Yeah. That happens all the time with us when we're putting new deals together, legal team and CPA on a call when we're putting the deal together, structuring it so that, things that Mike and I are not tuned in enough. We're not CPAs. We're not attorneys. This is where you got to have the right team members. So you set your deals up properly and efficiently. Moving on to some common tax mistakes or pitfalls. Are there any common mistakes or pitfalls that you see investors make when it comes to tax planning, or how can they avoid them?
A lot of common mistakes is you'll see that they want to do it themselves. So from a tax perspective, they're using TurboTax, they're using they're going to Joe on the corner that isn't licensed and doesn't have an education because he'll charge you $100 to do a tax return. In most cases, in those situations, they're going to err on the side of caution, and they're not going to do adequate planning, or they're not going to get the education that they need to make sure that they're doing the tax returns appropriately and accurately for what you're trying to accomplish. Again, I say it with that example. I've got 100 of them. Not talking to your CPA, not providing your CPA with all the information. When you come on to Provision, we ask you for 3 years of tax returns. I want your financial statement. If you don't have a financial statement, I want to know every asset that you own. Do you have a living trust? Do you have any other trusts? Do you have any gifting strategies? Do you have this? Do you have that? I want everything. And I always say to people, give me everything you have. Throw me everything, including the kitchen sink. And if I don't need it, I'm just going to throw it away. But if you don't give it to me, I'm not going to have it. So, those are the big pitfalls, is just not being transparent, not providing, everyone the information that they need to be able to appropriately plan.
Good stuff. Okay. So looking forward, you got future outlook and tax strategy trends. Obviously, we can see that depreciation is sunsetting each year. Are there any other upcoming changes or trends in the tax law that real estate investors should keep an eye out for? Maybe we're in 2024 or 2025 that you see is happening?
Not really. Everything's kind of stagnant right now. I tell everyone, write your senators, write your congressmen, tell them that we need, bonus depreciation. Everyone talks about bonus depreciation. It's a sunset provision. It was part of the 2017 Tax Act. It's been a part of every tax act all the way back to 2002. There's things that are done to drive revenue to be able to balance these acts that they provide. And by doing that, they sunset a lot of these. So bonus depreciation is going to phase out. There has been a bill that has been introduced over the last 3 years. Sometimes it hasn't made it out of committee. This last year, it made it out of committee, got passed by the House, and got squashed by the Senate. Everyone wants it. Everyone has different motivations on why they didn't vote for it. I say if you want it, you just need to talk to your senator or congressman, say how important it is to you, write them letters, do whatever you can, because it's important to the economy.
And when you say it's important to the economy, why do you see it that way? What's your perspective on bonus depreciation and why it's important?
So everything's incentive based. Our tax code is not consumption based. It's not saving based. It is incentive based. So we're trying to incentivize people within our economy to spend, to invest in things that are going to create rents, sales tax, places for people to live, places for people to work, things of that nature, so that we can then grow the economy, have more employees, have more taxes from the employees, from the tax, sales tax, property taxes, all of that. The second you stop giving that incentive or providing that incentive, it takes away from the opportunity. And people look at it as a investment that is not going to provide any type of return for a period of time. So you look at like a multifamily. If you have no depreciation and I give you $1 million, I'm not getting any benefit for that $1 million. It might take you a year or two to stabilize that property. You might get a 2% tick, 2% cash on cash return for the first couple of years, might bump up to 5, but currently I can get 5 at Merrill Lynch with a CD. So why am I going to invest in anything when I can just get the same amount of money in a CD that's liquid and doesn't have that exposure or risk? So you've got to incentivize that. On top of it, we're all primarily cash basis taxpayers. So if you're a W-2 employee, when you get $1 from a W-2, you pay tax on that dollar, correct? When you get $1 of interest, you pay $1, you pay tax on that $1 of interest. When you invest in real estate, you don't get to deduct that investment. That's just a non-deductible investment. If you don't have depreciation, you're essentially investing money without any tax incentives. So,
Yeah. That's good stuff. Well, if you guys enjoyed this show and people want to get in contact with you, Tim, what's the best way for our listeners to reach out to you guys?
You can if you just go to provisionwealth.com, up in the right-hand corner, there's a contact us page. It will just ask for some information, name, email address, things of that nature. And then, and on our team, we'll reach out to you and schedule an appointment with one of us. And then we'll have a meeting and figure out if we can help you.
Awesome. Well, thank you, Tim, for the wealth of knowledge you've shared with us here today. And year-end planning is obviously crucial. I hope you guys gathered that and you've got highlights into why and how to stay proactive with your tax strategy. And it can make a huge difference, as we all have just heard. So to all our listeners, we hope you found today's discussion valuable. There's no better time than now to get your financial house in order. Thanks again, Tim. And we look forward to having you back soon. And we'll catch up with you guys next week.